Norway is going ahead with one of the most ambitious plans to date for pulling investment from companies that mine and burn coal, after the parliament voted unanimously in favor Friday afternoon. The plan requires the country's government pension fund Global, GPFG, the world's second-largest investor with a market value of $837 billion, to divest its shares in businesses that rely on coal mining and coal-fired power generation for 30% or more of their work or revenue. Before selling, however, the GPFG can also urge companies to green up. The plan is not just to pull out, but to see if companies are moving to change their way of thinking, Christian Liberal MP Olav Syversen said after the vote. "It's a very dynamic decision we made today to try to change the attitude, but if it only change, the fund will probably pull out." The decision comes as pressure to take tangible action against climate change mounts. The issue will be center stage when G7 countries meet in Germany Sunday and Monday and in Paris at the global COP21 summit in December. As all countries are coming to Paris later this year to talk about what they are doing, this is a good way to show that investors also believe there has to be a change, for instance with coal, said Syversen. The Norwegian government will now draw up the criteria for choosing shares to divest and present them to the parliament in the autumn. The parliament hopes to implement the criteria by January 1, 2016. Overall, the GPFG's divestment is expected to affect 122 companies and $7.7 billion worth of investment, the Goserdswald, Greenpeace Norway and Future in Our Hands have calculated. While the finer details are still being worked out, the fund started to put the plan into action last week, after the vote became all but certain, said Labour MP Torstein Solberg. The Parliament's Finance and Economic Affairs Committee secured full backing a week ago for a white paper laying out the course for selling shares in the fossil fuel. The agreement, between 8 political parties, comes after 2 years of negotiations. Much like the divestment campaign against South African apartheid in the 1980s, the push to go fossil-free has picked up steam in recent years. In the U.S., more than 800 investors had pledged to sell over $50 billion in shares as of last year, and UK car insurance company AXA has announced it will shed $500 billion. But Norway's decision marks a major step forward for the campaign because as well as being a leading investor, the GPFG is also one of the world's most transparent. Now that the Norwegians are doing it, you can count on it that the divestment movement will get a push, said German MEP Reinhard Bütikofer, the co-chair of the European Green Party. "I think individual firms in Germany, for example, E.ON and we will now have to look for new financial sources. Doing that will drive what is necessary, namely to rethink the thoughtlessness of developing fossil fuels." In response to the vote, the trade group Oracle pointed to forecasts that global demand for coal is nowhere near slowing down, even with new and more stringent policies. Unlike other coal divestment programs, the GPFGs will provide a closer look at exactly which investments are dropped and how they were chosen, said Syversen, the head of Goserdswald. With AXA, on the other hand, only the value is made public. But still, nobody knows which companies it's going to divest from and exclude, Syversen said. The GPFG's divestment will also use a lower threshold for dumping shares, even compared with the one the Norwegian pension fund KLP announced last November. KLP targeted companies that get more than 50% of their business from coal, rather than 30%. This percentage is much more meaningful. It will exclude many more companies, said Syversen. The language talks about a company's activities, revenues and power production, while investors have mostly just been talking about coal mining without differentiating.